So welcome back, everybody. And it's great to have you here again. Last time, we went over my 5-minute test to spot overpriced stocks. And it was really about helping you avoid paying too much for stocks because a lot of stocks look exciting on the top, but when you start to scratch the surface, they don't look that nice. We also talked about checking the stock's PE ratio, not just in isolation, but compared to its history and the industry. And then we layered it with PEG ratio, which is price earning growth ratio, to see if you are overpaying for the growth of a stock. We also looked at revenue and net income trends because let's be honest, if the top line is growing but the bottom line is stuck, that's a red flag. And we also talked about tuning out hype. If you hear things like, oh, this is the next AI stock or it's the next Tesla, all that stuff, folks, that's hype. What is essentially doing is it's pushing the price higher, more in the short term. So those are the kind of things you want to watch out for. But here's the thing, just because the stock passes the 5-minute test, it doesn't mean it automatically is worth owning for the long haul. It might be fairly priced, but is it actually a strong company? Is it a company which we would call a compounding business? That's a question we're going to answer today. Today, I'm going to introduce you to what I call the 10-year filter. It's a quick, easy 4-step process that I personally use to decide if a company is worth owning for the long haul. But before I walk in, I want to tell you that a lot of investors, especially the new ones, they get fixed on just quickly calculating the price of the stock. They're like, is it cheap? Is it a good deal? But the truth here is that a mediocre business at a bargain is still just a mediocre investment. On the other hand, if you find a truly great business, even if it is not dirt cheap, it can convert into some serious long-term wealth for you. And that's exactly what we want. So today, we're not doing valuation yet. We're not going to do any DCF. We're not going to do any comparable company valuation. We're not going to figure out any price targets. Instead, we're asking a more fundamental question. Is this a business worth owning at all, and at least for 10 plus years? And we're going to answer that in just 4 easy signals, which I'm going to show you that are easy to find from open, freely, publicly available websites. So here's the first signal, which we look at in this 10-year filter, and I call it the return on invested capital, or ROIC. ROIC tells us how efficiently a company turns its invested capital into dollars, whether that's from retained earnings or from external capital, and how it converts it into actual profit. A business that consistently earns, let's say, 12% on its capital year after year, that's a sign of durable advantage. It means the business is making smart decisions, it has a pricing power, and it doesn't just need to overextend to grow. You'll find return on invested capital under the statistics section of Stock Analysis tab. So today I'm going to introduce you to a brand new website that I have been using. It's also free. It's called stockanalysis.com. You can become a member. I'm not even a member, but I can see like everything. So you just go there, click a symbol. So let's look at Microsoft, for example. So just type in Microsoft in stock analysis, and you go to financials, click on ratio, and under ratio, if you scroll down, there return on invested capital. Like I said, if a company is making 12% on, it's great. My benchmark is 10%. And why my benchmark is 10% is that if I were to invest my money in S&P 500, on average, it gives you 10%. So why would I invest in a company that doesn't give me at least 10% or doesn't give its shareholders 10% on the money that they have invested in different capital, like capital expenditures? So that's the first thing I look at. In Microsoft's case, it's very healthy, 19%. So certainly that's a great thing. And other thing is that, let's say why you need this. So let's say you have two companies. One company is making a return on invested capital of 5% and another is making 15%. That quickly helps you realize that which one is a better investment to go with, right? A 15% obviously is going to be better. And just for your information, return on invested capital is net operating profits after taxes divided by invested capital. So you can even search the formula online, but because this is pre-calculated and available very easily, you can just get it from there. So that was step number 1. And now I have two companies whose return on invested capital I've just copied and pasted from the same site, Stock Analysis, but I'm going to show you what they actually mean. So have a look. So first I'm looking at Pepsi on the left side. So Pepsi's return on invested capital has been sitting at 13%, and it's very stable 13%. And that's a very nice sign. Google, on the other hand, currently has, from the trailing 12 months, has a return on invested capital 21.46%, which is also great. It's greater than the 10% that I typically look at. And it's been fairly nice and consistently increasing since 2012 as well. So those are great signs. The step number 2 is a quick cash health check. So we're looking at how much real cash the business keeps after investing in itself. So what you do is you take operating cash flow, subtract capital expenditures, and what you get is free cash flow. So ultimately, that's what I'm looking at right now. And it also means that the business is self-sustaining. But if the free cash flow is not growing or it's consistent, that means that the company may be borrowing money to sustain itself, or it may be issuing more stocks to survive. Both of them are not good, because if they issue stock, it dilutes the share value of the investors. At the same time, take loans, then their current liabilities increase. So that's also not good. So in step 2, we're not asking how well the company is growing its investments yet. That I'm going to do later on in another step. Right now, all we're doing is we're just checking if the company has any cash left over after it has done its capital expenditures. That alone, interestingly, happens to be a pretty major filter. Now, I have some companies, and I'm going to show you how this whole thing pans out. So first, I have Pepsi. I have Pepsi and another company that I'm going to talk about in a bit. So first, operating cash flow. By the way, I want to impress upon you guys that this is just for educational purposes. All the companies that I'm going to go through, I'm not making any recommendations for you to buy or sell them. It's just here for educational purposes. So on the left side, we have operating income, right? And this is the cash the company brings in from core operations. In case of Pepsi, it's been consistently strong. It's sitting at $12.58 billion, which is fantastic, and it's been consistently very stable. In the middle, capital expenditures. And what that means is what the company invests back into its own operations, such as infrastructure, technology, and growth. It's always on the negative side because capital expenditure is an expense. So if you notice that the capital expenditure was increasing, then it has stabilized. So currently, over the last trailing 12 months, it's sitting at 5.31 billion, which is great. But this by itself doesn't really show us much. What we now need to look at is the free cash flow, because operating cash flow minus capital expenditures is free cash flow. So free cash flow, as I mentioned, which is just a difference between the two, you can see that even after reinvesting, Pepsi has about 7.27 billions in surplus cash in trailing 12 months. And overall, it's been very consistent. So the key takeaway here is that a business that can invest in itself, still generate a strong free cash flow, is a financially healthy company. It doesn't need to dilute shareholders' value by basically issuing more stocks, and it doesn't need to borrow just to grow. This is what the step number 2 is designed for. Companies that can stand on their own 2 feet. Also notice that the operating cash flow is 12.5 billion. Even after spending, they're still sitting at 7.27 billion. So that's a healthy amount of free cash flow remaining after 12 billion that was earned in operating revenue. So that's step number 2. This is the same kind of analysis that I've done on Google as well. So have a look. Operating cash flow has been consistently growing, which is great. Currently sitting at 132 billion. Capital expenditures have also been increasing very nicely, but because they're increasing, notice that the operating cash flow is growing up. But because they're increasing as well from the capital expenditures point of view, it's important to note what's happening in free cash flow. Notice that even though the capital expenditures have been increasing, they're currently sitting at negative 57.72 billion. Free cash flow has been very nice, 74 billion. So even after they invested so much in capital expenditure, they still had more than that available in free cash flow, which is money that they can use for giving dividends or whatnot. But that free money is a fantastic sign. So that's Google for you. Now we go to the step number 3. Step number 3 is a big one. It's about reinvestment efficiency. It's not about just spending the money. It's also about what the company, when it spends, what that spending gets the company. Okay, so you want to check, is the company turning its reinvestments into actual growth? That means looking at whether the rising capital expenditure or the research and development cost is matched by the rising revenue and profits. Okay, so a company might be pouring money into its factories or software or new markets, but if the sales and the net income are flat, that's a big red sign. And it tells you that the business may not be using its capital wisely. I personally usually compare capital expenditure to operating cash flow and then see if the revenue and the net income are rising alongside. Remember, a great business doesn't just grow. Great businesses grow efficiently. They know how to reinvest and get results, and that's what we are looking for. Now, since there's a lot to check here, I've created a slide with 2 tables, which basically show you what's good and what's considered not so good. So In this slide, I bring both sides of the story together, what strong reinvestment looks like and what weak investment looks like. So let's start on the left side, which is what a strong reinvestment looks like. In a strong business, capital expenditure is either gradually increasing or staying very stable. And that's a sign that the company is reinvesting in a disciplined way. Free cash flow should be positive and growing, meaning that they are not just earning revenue, but also are able to keep real money in the company after they have made their investments. You want to see the revenue growing consistently 5 to 10 years and also net income rising at the same time alongside. You don't want to see a rising revenue and net income going down. Those are not good signs. And you also want to check how that investment ties to results. So if capital expenditure leads to higher revenue or better profits, which is net income, that's a sign that the company is able to put its money wisely and those investments are immediately having an effect into the company. But now let's look at on the right side of the table or the slide and see what weak reinvestment efficiency looks like. So number one, capital expenditure. So if in a company you see the capital expenditure shoots up, but there is no growth to show for it, that's a red flag. Next is free cash flow. So if free cash flow might turn negative or even continue to shrink, those are also not good signs because they're essentially signs that the company is spending heavily, but not getting much back. So if the revenue is flat or if the revenue is falling while the sales rise, that typically is a sign of rising costs or poor project returns or inefficient capital use. The bottom line is that the smart businesses grow with discipline, whereas the weak ones basically throw money at problems and hope that something sticks. This slide helps you tell those differences. Now I'm going to put what I have just spoken about into practice while talking about how it fares on Pepsi and Google after that. So here's a quick case study. Let's have a look at Pepsi. And by the way, again, I want to re-impress. This is just for educational purposes, not a recommendation to buy or sell. We're simply using publicly available data to see how the framework applies in real life. So first, let's look at the revenue. So here's the revenue of Pepsi since 2020, and it also shows you what's been happening in trailing 12 months, which means TTM. So you'll notice that from 2020 till the last 12 months, the revenue has steadily climbed, and it's currently sitting at $91.52 billion. And this tells you that there is demand and the business is expanding. Remember, revenue is directly tied to sales, right? So the company is making money. Second is net income. So net income has also been consistently growing. Now, it's not spiking, but has been gradually increasing. And this shows that there is good cost management and the margins are also healthy in Pepsi. Let's look at the capital expenditures. So notice that the capital expenditures have increased over time, and that's perfectly okay because it reflects continued reinvestment of the company into the operation, building new capacity or innovation. But the key here is free cash flow. Free cash flow in Pepsi has remained positive throughout the entire period, even though the capital expenditure was increasing. Now, some fluctuations are perfectly okay, and that they happen, which are very normal in a company. But overall, Pepsi has been generating surplus cash flow year after year. And you can also look at the magnitude of it. So the capital expenditure TTM has been sitting at $5.31 billion, whereas the free cash flow is sitting larger than that at $7.27 billion. And the revenue is $91 billion. So compared to revenue, the capital expenditures have not been that much, still generating a handsome free cash flow for this company. So those are good signs. Now let's do the same thing and reflect back into Google. So look at Google and let's see how well they reinvest in their own growth. So on the left side, you'll see the revenue, and the revenues have been very handsomely rising year after year and nearly basically doubling. So they're somewhere close to 180 billion in 2020, and now they're sitting close to 360 billion. So that's almost 2 times over the past 5 years, which is beautiful. Now let's look at the net income. So the net income has also been growing, and it's been actually growing even more impressively. So it's gone from somewhere close to 40 billion in 2020 and trailing 12 months sitting at 111. So that's more than 2 times that the company has grown, or almost 3 times the profitability has grown. And what makes this really interesting is the capital expenditure chart. You'll notice that capital expenditure has almost tripled since 2020. In 2020, it was, so it's nearly tripled from around 20 billion to currently sitting at 58 billion. Now, that could easily raise a red flag in a typical situation, but we need to compare it to see how the free cash flow has been doing. And if you look on the right side, despite very massive investments in capital expenditure, Google has still been able to generate more and more free cash. So it went from somewhere close to $40 all the way now sitting at $8 billion. So that's exactly the kind of things that we want to look at in signal three of this 10-year filter. Strong reinvestment efficiency, which means in this case, the capital expenditure was big, but also the results, which were the free cash flow, have been able to match. This company hasn't just increased its capital expenditure, but they have a growth in net income and the free cash flow to show for it, which is fantastic. Later on, I even have companies that show you that they don't do that well. Yes, go ahead, please. Who's this?
Sorry, excuse me, this is Vijay. But maybe it's nitpicking, but does it not show that the expenditures have increased dramatically, but the free cash flow is not going up as fast? Is it because it's probably they're investing for a longer term? It doesn't seem to be increasing as quickly. Yes, it's increasing, but not the amount that they're investing, though. Am I reading this wrong?
So look at this. First of all, we want to see that the free cash flow has been increasing, which is good. Now, what's interesting to notice, despite the heavy capital expenditures, their free cash flow still increased. So where did this money come from? This growth clearly came from the net income. And later on, I'm also going to show you operating cash flow. It may have come from there. So there is money coming in. Suddenly, they might have had a heavy jump and they invested in capital expenditure, yet still able to maintain a consistent growth in free cash flow. If you want to investigate further as to where did they actually spend, for that, you have to open up their annual reports, and that's going to give you that kind of an indication. But overall, as far as running this to understand, is this company worth holding for a longer time? As long as the free cash flow continues to grow in a nice way, it goes to show that they're certainly getting that money from somewhere. Is it from diluting shares? I don't know, but that's I'm going to check in a later stage of the same test. I'm going to show you that in a later filter.
Okay. Thank you.
Okay. All right, guys. So now the final step. So this is the final step, and it's about something that often gets overlooked, which is how does a company treat you, the shareholders? The business can be profitable, but the way it manages its capital and communicates with shareholders makes a big difference in the long-term returns. So the first thing I check is book value per share. So is it rising steadily over time? And it is that shows that if the company is building shareholder equity and not just destroying it. The second thing I look at is the count of shares. So I just mentioned to Vijay that a company may raise money by issuing more shares, right? So that's a very important thing we need to check, because if they issue more shares, what they're doing is they're diluting the value of shares to the other shareholders. So that's another check that we do in this last step. And by the way, when we look at which shares are outstanding, we look at diluted shares outstanding because it includes all the potential dilution from stock options, RSUs, which are restricted stock units, and that are all part of employee compensations. And we also look at this kind of share dilution, also looks at convertible instruments. And the third thing is if the company is doing any kind of buybacks, because we want to make sure that they're doing it in a more sensible way, not just buying back shares when the prices are inflated or offset aggressive stock-based compensation. Other thing we look at is based on how many shares are outstanding. If the shares outstanding are going down, that's also a good sign that the company is buying back shares and reducing the total number of shares in the market, which basically increases the shareholder value. Remember, supply and demand, that's where this comes in. All of this helps us answer the question, is the company acting in a way that respects long-term shareholders or just growing at the expense of its shareholders? So how do we do that? We do that by looking at these two charts. So this is how it plays out in real world. Again, folks, this is for educational purposes. I'm not telling you to go buy these shares. So on the left side, you see the share count of Pepsi. And this is over the past 5 years. And what stands out is how stable this is. There are no aggressive dilutions happening. So notice the shareholders, the number of shares outstanding is very stable. If it was increasing, that means a company is issuing more shares. And when they issue more shares, they raise more money, but that dilutes the value of the share price for other shareholders, which is a person like you. So in this case, this is very good. They maintained a consistent number of outstanding shares, so they have not diluted the shares. On the right side, you look at book value per share. And this is climbing steadily in turn the case for Pepsi. And it tells us that Pepsi is actually growing the intrinsic value of each share. So when we think about shareholder respect, this is exactly what we want to see. We want to see a controlled share count and growing value per share because it shows discipline, long-term thinking, and a focus on owners, not just the optics. Now I'm going to show you where you actually get this from. So there is another website. Again, it's freely available. It's called ticker.com, T-I-K-R, ticker.com. So you go to ticker.com and look at a company. So I'm going to look at, let's say, Microsoft. So here's Microsoft. Now, if you go to balance sheet, let me expand this. So if you go to ticker.com, click on detailed financials, and then click on income statement, and then scroll down under income statement, you're going to see a line called weighted average diluted shares outstanding. That's what you want to click at. And when you click on this, scroll to the top and a chart is going to come up. So in case of this company, this is American Airlines. You notice that in American Airlines, the number of shares outstanding has been increasing. This means this company is diluting the shares. They're selling more shares to raise money. Interestingly, I actually happen to have a case study on this. So I'll pause more discussion, but on this specific share, I'll talk about another company. So let's go to maybe Tesla. So click test, type Tesla in the search box up. Again, make sure detailed financials is clicked. So this is financials, and go to income statement and you go down and let's look for weighted average diluted shares outstanding. Click on that and note that in case of Tesla, they have actually been issuing more shares. So in 2020, the shares outstanding was 3.2 billion, and now they're sitting at 3.49 billion. Anyway, something to look at, right? So that's where you get this. The second thing is book value per share. So where do you get that? You click on ratios, scroll down. Is it here? I might be in balance sheet then. Go to balance sheet. There you go. Book value per share is in balance sheet. So you click on this, scroll up. Oh, it's showing me the shares outstanding. So I'm going to delete that option. So there you go. So notice in Tesla's case, the book value per share has been growing. So that means the intrinsic value of the shares in this case has been increasing. So that's a good sign. Similarly, you can check some other company if you want. Let's look at Apple. So again, balance sheet, scroll down and book value per share. And in Apple's case, it's been rather stable. It went down here, but then that's what this is telling you. So folks, next I want to show you the same thing in case of Google. There you go. So I have the same thing for Google as well. This is not in the portal that I showed, which is ticker.com. I have already copied those charts, but to show you what's happening in this case. So you notice in Google's case, on the left side, you're going to see book value per share. It's been rising consistently from around $13 or maybe $15, $16 in 2020, and it's gone up to the north of $25 over the trailing 12 months. It also tells you that Google is growing its actual value behind each share and not just generating earnings or reinvesting in a way that builds equity, real shareholders. And on the right side, we want to see the number of shares outstanding. We want to see it stable. But in this case, you notice that it's going down. And what is this telling you? This is telling you that the total number of outstanding shares in the market are reducing. And when do they reduce? They reduce when the company buys back shares. And when do they buy back shares? Either they have a lot of free cash flow. Remember, we checked the free cash flow of this company. They use that free cash flow to buy back shares. So remember when Vijay was asking that, how come the free cash flow didn't shoot up? This is what they did. They probably bought back shares. So they showed a consistent growth, not a crazy jump, but they would have used that money potentially to buy back shares. And when they do that, the total number of shares shrink in the market, that increases the shareholder value. So your shares become more valuable because the total number of shares outstanding are going down. So these are all good signs. Essentially, it shows that Google is not just profitable, it is disciplined, it's increasing the value per share while keeping dilution in check. And that's exactly what we want to see in signal number 4, that the company is growing in a way that respects its shareholders. All right, guys. Now, I'm going to go through the last slide later, but now I have a whole bunch of case studies that I'm going to walk you through. So here's a first case study. So I had posted in our Telegram group if there were any stocks people wanted me to analyze. And I analyzed a whole lot of them. Obviously, I can't analyze all, but there were a set of them I ignored because they were very similar. And if you go through them, you'll notice that they're all pretty good. So they passed this test, but I welcome you to run through those yourself. So first is Nvidia. Notice the first thing we're going to do is check the return on invested capital. That's our signal number 1. What we're asking in signal number 1, is the company good at turning investments into profit? And the answer in Nvidia's case is a resounding yes. ROIC in case of Nvidia has gone up very handsomely, and from somewhere close to 15, 16%, all the way almost 70%. That's a return on invested capital, and that is amazing. Second thing we look at is free cash flow discipline. For free cash flow discipline, we want to look at whether the business is generating real surplus cash after it does its reinvestments. Despite a significant capital expenditure that this company has had, which is to be expected at a company that's scaling at this very high level, free cash flow has actually exploded. How do I know that? Check this out. It started somewhere close to just maybe a couple billion, now sitting at $72 billion. This tells us that Nvidia is not overextending or burning its capital. It's funding its growth and it's still producing very huge cash flows. The next thing we look at is reinvestment efficiency. Right? So reinvestment efficiency is basically, are those investments actually driving growth? And again, look at the results, which is the revenue has jumped from somewhere close to $30 billion all the way up to $148 billion in the trailing 12 months. That's fantastic. Net income has also soared from, I guess, couple billion dollars. Now net income is sitting at $76.77 billion, which is absolutely fantastic. And the operating cash flow growth has also been very explosive. Check this out. So operating cash flow went from very little, jumped up in 2024. Actually, sorry, I'm looking at the wrong, this is a wrong chart. This is operating cash flow growth. I need to look at operating cash flow. So I'm going to just open that up in real life right here in stock analysis. So let's look at Nvidia financials, cash flow, operating cash flow. Look at this. The operating cash flow has insanely jumped. So this is absolutely fantastic. The chart in my presentation ended up being, I copied the wrong one, which is just about growth. But what we want to look at is the operating cash flow, which has been phenomenal. All right, guys. Next, we want to look at signal number 3. Signal number 3 is, or signal number 4, which is shareholder respect, which is basically, is this company treating its shareholders with respect? Are they helping grow the book value per share, or are they diluting their share value? So have a look. The book value per share of this company has done really well, somewhere close to less than 1. And it's now the book value per share has gone north of 3. So that's a huge jump, almost 3x, more than 3x. And when it comes to the shares outstanding, look, a very consistent, albeit I believe that they have, in the last little while or trailing 12 months, the number of outstanding shares has actually gone down. You'll have to like microscopically increase it. But previously noticed that this blue line was touching the 25K line. It's now gone below that. So that means this company has even bought back shares, which is a good sign. Next, let's look at Rio. So somebody sent me this company. So Rio Tinto, from the lens of our 10-year filter, let's see how this does. This is a mining giant. And what we want to know is, how has this held up in the long term? And I also want to tell you guys that this company is not a North American company or an American company. So the information about book value per share and the number of outstanding shares history, I couldn't find on those websites. So whoever asked me this, please look for these more in your country. You'll probably be able to get those, or perhaps you can even try to calculate the book value per share yourself. Okay, so first thing I want to look at is return on invested capital. So notice that in 2021, it spiked almost close to 30%. But ever since then, this number has dropped and stabilized close to 12% in the most recent period. Now, for a cyclical business like mining, this is not necessarily terrible. It tells me that the returns are heavily dependent on commodity prices, not necessarily internal efficiency. So I would put this, my assessment of the signal, at more like neutral, acceptable, because it's a cyclical pattern. The second thing is free cash flow. So we want to see if Rio is generating stable free cash flow. So on the left side, you're going to notice that I have free cash flow right here. So the free cash flow has declined sharply since 2021, right? That's when it peaked. And now it sits somewhere close to $6 billion. That's something to keep in mind. The operating cash flow is still healthy. It's sitting at 15 billion. So it had spiked, but then it stabilized at 15 billion. But obviously it's come down. And capital expenditure has also been fairly stable. Just only recently it went down to $9.62 billion. So this is a slight increase last year. The good news is that the company is still generating cash, so $5.9 billion. The concern is that free cash flow is trending downwards while the capital expenditure is creeping up. So that's something to keep in mind. So I would put this as more on a cautionary side. And the margin of error is shrinking in this company. Now we got to ask the question, is the CapEx translating into actual growth? The revenue has remained flat to slightly down since 2021. So as you can see, here's the revenue. And because the net income has also been going down, revenue has been consistent, but net income has been going down, that basically puts me more on a cautionary side when it comes to signal number 3. The last signal is something that I do not necessarily have, which is the number of shares outstanding and the book value per share. So whoever asked me this, please go ahead and check that yourself. Next, let's look at Costco. Costco is a major giant, right? So first thing we want to see is what the return on capital has been. The return on capital is, which means has a company generated strong profits relative to what it reinvests. Costco has consistently delivered return on invested capital of 13 to 15%, and it's currently sitting at 19%, which is absolutely fantastic. Now, this may not look very flashy like some of the other companies that we have seen, but it appears to be a very dependable company, which is exactly what you would expect from a company like Costco, which has low margins, high volumes, turning out to be a dependable company. Signal number 1 is a pass. Signal number 2 is free cash flow discipline. So we want to ask ourselves, is the company generating real sustainable cash after its investments? On the left side, you're going to see that free cash flow right here has been consistently positive and holding steady and currently sitting at almost 6.9 or $7 billion in recent years. If you look at the above chart, which is the operating cash flow, you'll notice that the operating cash flow has also been very stable as you can been growing. Currently sitting at 11.97 billion in the most recent year. Even with the capital expenditure of almost $5 billion, Costco is generating plenty of money to create excess cash of free cash flow, $6.9 billion. So that's a good thing. So passes my signal number 2. Signal number 3 is reinvestment efficiency. So next question we want to know, are those investments actually driving business growth? Which is, has the revenue been growing steadily and what's going on there? So if we look at the revenue in case of Costco, you notice that the revenue has been growing steadily very nicely, currently sitting over the last 12 months at $264 billion, which is good. Operating cash flow has also been doing well. So this basically, and they're both growing in the same direction. There are no wild jumps like some of the other companies that we saw, but this is a clear evidence that the reinvestment is paying off in a stable, predictable way when it comes to this company. So this passes signal number 3. Next, we look at signal number 4, which is shareholder respect. And we want to know if this company, how that has been happening. So if you notice on the book value per share side, the book value of the company has been growing very nicely. And at the same time, the number of outstanding shares had stayed very consistent. So this company has not sold more shares to raise money. And that means that this company also passes signal number 4. So in summary, Costco may not grab headlines like other tech companies, but it's a quiet compounder with consistency in cash discipline, shareholder alignment. In essence, it passes my 10-year filter, and all those 4 signals are good when it comes to this company. Next, let's look at Estee Lauder. So Estee Lauder is a company that I actually have a small portion of in my own portfolio. And it's a company that, for those of people who have been following me, it's a company I analyzed in 2023. And at that time, the numbers looked very good, but that's not necessarily the case right now as we revisit it with fresh eyes. And let's put this through the 10-year test because the data has changed now. So first thing we look at is return on invested capital, which is the signal number 1. And this tells us how efficiently the company reinvests its capital. ROIC peaked in 2022, and it was around 15%. But ever since then, the return on invested capital has fallen and currently sitting at 5.48%. Remember, my threshold is 10%, so my signal number 1 fails. Second is free cash flow discipline. So we want to see if the company is producing sufficient cash after investing in its own growth through capital expenditure. If you notice that the free cash flow in this company's case has fallen down significantly. So it was sitting at $3 billion. It's now sitting at $948 million. And that's pretty low, especially comparing that this company is a multi-billion-dollar company. So the operating cash flow of this company has gone down to $1.5 billion. It had almost touched $4 billion in 2021, but now sitting at $1.5 billion. Capital expenditures were heavy, but they have reduced the capital expenditure in this company. In essence, right now, if I look at from the signal 1's point of view, it's not looking good. Signal 2 is not looking good. I would, from a signal 2 point of view, to say it's a cautionary tale because they have reduced the capital expenditures, but while the cash flow is positive, the margins are thinning in this company, and the free cash flow has fallen very significantly over the last few years. Then let's look at signal number 3, which is reinvestment efficiency. So let's see if the investments are paying off. Notice that the revenue has stayed flat. In this case, revenue has stayed very flat and also started to decline over the last little while, currently sitting at 14.76 billion. And net income has also dropped heavily, where recently it has become a loss-making company. So it has gone in a loss of $871 million. This tells us that the reinvestment is not translating into better results and margins are heavily under pressure. The next thing we need to look at is signal number 4, which is how well is a company managing its shareholder capital, which is book value per share, etc. So notice that the book value per share has continued to go down, right? It has declined, not so much, but it has declined ever since its 2022 peak. And although not that drastically, the shares outstanding have been very flat. So there has not been any major dilution. There have been not any major buybacks. So my response, it's mixed. It's not harming shareholders when it comes to the fourth signal, but it's not actively rewarding as well because the book value per share has been going down. As someone like me who owns a stock, my composition or allocation towards a stock is only 0.5%. So only 0.5% of my portfolio is towards this position. I am watching it closely, but I am not adding any more of this share. I initially bought it when the times were better for this company, but as a long-term investor, we have to ask, would I still buy it today? And based on the current data, the answer is no. But because I have such a small position, I'm not necessarily going to get rid of it. But things like these happen when you buy a stock, their fundamentals deteriorate, and then you have to analyze that based on what I have. Do I want to just get rid of the stock, or do I want to hold it? Do I want to just monitor? So this is the reality of the stock for me as of now. Now, I want to put the same kind of test to another company, which is American Airlines. So American Airlines is a very popular company, but let's see how that fares when it comes to my 10-year filter. So on the surface, some things look great, but other things may not. So let's have a look at this company. So notice in 2022, the return on invested capital in American Airlines was very bad, south of negative 20%. Then it started to turn around, but even right now, it's not sitting at a very nice number. It's just only at 5.78% return on invested capital. So while the company has improved, it's not looking very impressive right now. So signal 1 fails. Signal 2 is free cash flow discipline. So on the bottom, you'll notice that the free cash flow of this company was very bad, minus $7.5 billion in 2022, although it has recovered, but it's only sitting at $1.5 billion. So it's gone up, but it hasn't done all that well when it comes to free cash flow. Now, we can also look at the operating cash flow of this company. So the operating cash flow is at 4.2 billion, again, from a very negative to $4.2 billion. And the capital expenditure is right here. So capital expenditure is minus 2.6 billion, although it's been very stable over the last little while. But with a $2.6 billion in capital expenditure and a free cash flow of only 1.5 billion, it's a cautionary tale. Now let's look at the reinvestment efficiency. So here's where things break down. Operating revenue is up at $50.3 billion. Now, that hasn't grown much since 2022. Hasn't grown that much. So it's been, although growing, but not that much. So net income of this company is sitting at $1 million. And that's a razor thin margin on a company that had an operating revenue of $50.3 billion. So even with all the capital expenditure, there's no real improvement in the margins. So yeah, they're putting money, but that's not really improving the net income of this company. So I would put this as my signal 3 as a fail. Now, last, we want to see shareholder respect. So what has been happening with the outstanding shares? So notice the number of outstanding shares has been increasing. So when does it increase? When the company issues more shares. So that means the company's actually been raising money by selling more shares, which dilutes the shareholder value. It's not a good sign. And the worst yet, look at the book value per share. Instead of being positive, it's actually negative. So not a good sign. So in my case, this would fail my 10-year filter. So hope that gave you guys an idea of how to put this 10-year filter to a test. Now, I want to close off this with some important ideas because I know a lot of people are very eager to jump straight into stock valuation. They want to take the DCF. And also there are tons of websites, right? Like you can go to a website, get the fair value of companies, figure out what the price targets are. But here's what I've learned. These analysts are paid to produce fair market values, or there's automated financial models that take numbers and just immediately churn out what the fair market value is. Remember, a mediocre or a fragile business, even at a discount, is still a bad long-term investment. That's why investors don't start with valuation. They first start by asking, is this a business that I even want to own for the next 10 years? That's exactly what the 5-minute test, first of all, helps you. It's a quick filter to quickly tell you whether the stock is overpriced or if it's a hype-driven stock. The framework that I just mentioned to you, this helps you go one level deeper. It contains 4 steps: return on invested capital, free cash flow, reinvestment efficiency, and shareholder respect. But let me also end this by saying that what I've just told you isn't necessarily the full picture. Knowing that the business is worth owning is one thing. You still need to learn if a company is financially stable, and is it likely that it's going to collapse? You need to figure that out. How do you figure that out? There are certain other ratios that you need to look at, more from the balance sheet and some in the collective side. Second, you want to know when to invest, how much to invest, how to structure your portfolio, how to manage your risk, and how to read earning reports and technical signals. Those are also important. Otherwise, you're missing out a big chunk. Now, that's a broader skill that separates amateurs from long-term investors. But if you apply what I've just covered today, you are already ahead of the pack. You're not just going to be chasing prices or trusting algorithms. You're based on what I've taught you guys today, you're going to be looking at what really drives shareholder value. And these are steps that are important, but obviously recognizing that they don't guarantee returns, but they will still help you avoid the big mistake, which is you're going to be able to figure out what are strong businesses and also filter out what are not very strong businesses. And ultimately, it's going to help you think like a wise investor. And finally, just to be clear, this entire session that I shared with you guys was for educational purposes. I'm not recommending any specific stocks or investments here. Just sharing a process that helps you think more critically and independently. And in essence, I actually use these in my own investments. Folks, that brings me to the end of this session. I thank you for sticking around during your lunch hour. I'll open it up to you all if you guys have any questions. Thank you.
I have a question. Yeah, in regards to 10 years, do you have like stocks that are essentially emerging companies where you don't look at a 5-year history, but you look at quarter to quarter, a little bit more short term? Or how do
Sorry.
you structure your portfolio where you have long-term investments and then short term, and how do you evaluate the short terms?
Most of my investments, I would say, are long term. Okay. I have done a lot of trading. I have done a lot of speculative investments. And what I have learned over my years of experience is that strong companies are the ones that are going to give you the returns. Now, that doesn't mean that I don't have speculative investments, but when I have a speculative investment, which is one you're saying, which is, let's say, a knight in shining armor, something that everybody's talking about, and I've done analysis on their financial statements, and looks like, yes, it's doing well. It doesn't have long enough history, because obviously a new company is not going to have a long enough history. But whatever history it has, it's a good history. I never buy based on hype. I always check the fundamentals of a company, which are what are the financial statements telling me: cash flow statement, balance sheet, and income statement. Now, a new company is not going to have a history. However, if I still want to buy it, what I do is I classify that investment in my portfolio as a speculative investment. What is speculative investment and how does it differ from my aggressive investment? The difference is very clear in allocations. That's it. So if I allocate an average long-term investment company in my portfolio, let's say is 2 to 3%, a speculative investment is going to have anywhere from half to 1%, no more. So even if I lose 50% of my investment there, I may only drop a 0.25%. So it's not even going to affect me. I also make sure that speculative investments don't exceed 5 to 6% of my whole portfolio. Right? It's about wisely allocating. That's why I remember when I told you in my last slide, which was titled Bringing It All Together, I said, now that you know how to figure out whether a stock is a contender for long term, the story is not done. You still have to know, does this company have strong liquidity, which means that are its balance sheets strong? And then you need to understand portfolio theory. How much to invest, when to invest, that's just technical analysis, when to keep adding more, when to stop. Those are all important aspects, which I may cover later on, but hope that answers your question.
Yeah, that makes sense. Makes sense.
Okay, good. Remember, a lot of people, and interestingly, I've been one of those, a lot of people will put a huge chunk of their capital into one stock. And then when the one stock drops by 20, 30, 40%, they lose their net worth. And I have done that. And this is what compelled me to start walking this journey, so I do not make those mistakes again. Interestingly, I made all that money back and a lot more. And that's why I'm sharing this wealth of knowledge with you all. Okay, guys, anybody else? Go ahead.
Sorry, I have another question. Commodities are pretty popular now, especially if you are at a point where you want to have some defense stocks and stuff like that. Looking at gold, platinum, silver,
Yeah.
I noticed that like a couple years ago, I've invested in gold and it just essentially shot up, which is fantastic. And I see the differences between how things are going with the commodities versus where equities are at right now. Do you invest in commodities, and like what portion do you allocate for commodities? That all-time highs increased 30% this year already, if not more, at $3,300 an ounce. And silver's yet to caught up, and I feel like platinum and copper's yet to caught up. So just wondering what your perspective is in terms of commodity trading rather than evaluating companies. Yeah.
Okay. So I'm going to talk about commodities in a multiple aspect because you asked a few questions inside there. So one, you talked about commodities, you talked about defensive stocks. So first of all, let's discuss what commodity actually is. So commodity essentially is, you write gold, silver, essentially anything that goes up based on supply and demand. The difference between equity and commodity, or stocks and commodity, is that stocks are performing assets, commodities are non-performing assets. What does that mean? It means the following. When you buy a stock of a company like Microsoft, you're buying a part of Microsoft. And what does Microsoft do? Microsoft produces more iPhones, Mac, laptops, blah, 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 right? It produces things. That's called a performing assets. It's producing things, selling and making money off of that. That is what increases the value of that company. Fair enough? Commodity, on the other hand, doesn't produce anything. I have a gold ring. It's been the same over the last 15 years. It hasn't changed. It hasn't made me more baby rings. The reason the value of commodities go up is purely based on economics, which is supply and demand. When the demand goes up, the supply goes down, obviously. And when that happens, the price goes up. An asset like gold, the reason it goes up is because people use it as a countermeasure to the performance of equities. So when there is risk in the market, it's common that the investors shift their money into gold. As a matter of fact, when you watch my market analysis videos, I will show you, and I often analyze that, oh, look, the bonds are going up and the gold is going up and the stocks are going down. What's actually happening is there's cash rotation happening. Do I do that? I actually do not invest in any commodities. Why? Because in the long run, the stock market does better. And I'm not just talking about it. Let me prove it to you. So here, first of all, I'm more of a lazy investor. I invest in a way that I would rather just put my money in companies and just stick with the same philosophy and keep investing for the long run. Certainly, other people have different philosophies. I'm just a lazy investor. I want to see my money go in one direction. When the market goes down, I end up buying more. But now to answer your question, how does this do in the long run? So this is S&P 500, and you notice the blue line represents the gold ETF, which is GLD. So right now, gold has done well. Obviously, why? Because the stock market is down. But let's look at, in a slightly smaller term, here. Notice since 2012, S&P 500 has returned 350%, gold has returned 86%. So if I had put all my money here, I wouldn't have done well. And also, let's zoom in a little more. Let's look at the dip that happened here. So this little curvature. Why did the curvature happen? Why? Because the S&P 500, or the stock market, was consistently going up. Now, let's superimpose another ticker here, which is NASDAQ. So I'm going to put QQQ or NDX. Okay, so then I'm going to superimpose NDX, which is the index. Same scale. Look at the performance of NDX, which is the NASDAQ. I'm not even saying let's pick individual companies, because why do I analyze companies? Because I want to get the alpha. I want to do a little better than these. But if you don't want to do any of that, just put it in the market. Well, I'm showing it to you. They don't do that well in the long run. This is why I don't put money. Because remember I said I'm also a lazy investor? I don't want to necessarily keep shifting money from gold to indexes to stocks. I would rather I have a certain portfolio of good quality companies. And then when that company, as long as the fundamentals are good, dips below its fair market value, all I want to do is buy more. I'm just a buy more guy. I'm not even a sell much guy. I would only sell if the fundamentals of a company go down. So that's why over the long haul, my portfolio goes in one direction. Right? Short term, yes, it goes up and down, but I don't shift back. Hope that answers your question. Vinod.
I have one question. So this the 5-minute test and then this 10-year checks, right? Is there a way like we can basically automate it, like using some programming where we just give a say ticker symbol and then we get these reports?
Yeah, of course. You can automate it now with artificial intelligence. I'm sure there's a lot of fancy things we could do, right? This is not stuff we could do when we started doing these videos 3 years ago. I haven't done it. However, I do on my own. I have a big Excel model where I have all these charts that just appear. So I just put in some information and I can just quickly see, oh yeah, okay, this is what's happening. So I don't use artificial intelligence to tell me, I can just eyeball it.
Right.
But before you get to that, everybody who's watching, just go through my webinar and run through these over and over again and go through a portfolio, go through your own portfolio, look at all the stocks and run this test on it. And then see what it says. And then if you all have questions, post those questions on Telegram and let me see how I can answer them. It also gives me a chance to understand, learn about new stocks that you guys have. All right, guys. Anybody else? Thank you, everybody. Enjoy your lunch. Bye-bye.
Thank you, Amit.
Thanks, man. Thanks.
Thank you.